Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure recognize two official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, welcome to Qingyi. Good evening. Today is Friday, November 14th. I'm your analyst, Jiang Ji. Remember to like, subscribe, and share for us. If you have any investment questions, feel free to leave a comment for me. Whether it's on the message board or in the live chat, I'll see every one of your questions. For questions I can't answer right away, I'll address them one by one next class. Hello again, everyone. Just before class, some students asked why the US stock market has been dropping and why indices like the Taiwan Index Futures and Mini Taiwan Index have seen such big pullbacks. In a moment, I'll explain to everyone what exactly is going on. It's not that the whole market has turned into a major bear market, far from it, but after a big rally, these pullbacks are something you really need to pay attention to. All right, everyone, happy Friday and happy weekend. Let me see who's online right now. Hi, Wan, good evening. And who is this? Swanpun? Good evening, long time no see. My Daitzi and Yolun, who's flying somewhere, good evening. Ki Pao Shui, hello, and Franklin as well. Franklin also mentioned that it's rare for him to be at home recently. Usually he listens while driving. Thanks for your effort. Really appreciate it. You can also give a thumbs up if you're done. Good evening, Hector, and good night to Ice Voice. Also hello to Lewis Young. Good evening, everyone. Now, let's first take a look at today's investment highlights. The first one is quite striking. After the start of December, there's been a major clearing out, just like we mentioned at the beginning. In the US futures market, there's now a significant downward adjustment, which of course continues the pullback momentum we saw in the US stock market yesterday. So what's the main reason for this? It's because many Federal Reserve officials have recently expressed rather hawkish positions, meaning they're inclined to keep interest rates unchanged. For the whole of December, during the government shutdown, a lot of economic data wasn't released, so even Fed officials were basically feeling their way in the dark. So overall, it looks like rates will remain unchanged throughout December. And because of this decision to keep rates unchanged, we can see that with the hawkish, tightening stance remaining the same, it's naturally somewhat negative for the US stock market. So in a bit, I'll also share with you which officials have taken what positions and whether there have been any changes in their stances. In addition, after the US government was shut down for nearly 43 days, it has now reopened. So what kind of situation will we face next? This includes the impact on economic data, the economic shock, and what kind of effects the US economy, currency market, or stock market experienced during this period. We can see that economic advisor Hassett also made some comments today regarding the impact on GDP, and I'll be sharing those details with everyone shortly. Because of this impact, the market also has concerns and doubts. There are worries that in this fourth quarter, the gross domestic product may show signs of an economic recession in the US. As for the industry side, yesterday, a few students, like Xiaolong and a few others, asked about Apple. Why is it that during the recent pullback and consolidation of the Magnificent Seven, Apple has instead stood out? Besides the iPhone 17 selling extremely well, today Apple also received a significant piece of good news. The question is, how did Apple manage to leverage something small for something big? And how did it break into the Chinese market and secure such orders? We need to pay close attention to the follow-up news related to Apple. In addition, Applied Materials has also released its financial report. For both the third and fourth quarters, the results were in line with expectations. But why did the stock plunge even though the earnings met expectations? What fundamental issue did Applied Materials encounter, and how is it related to the US-China trade war? So tonight in our group chat, we'll have a good discussion about these topics. Good evening, everyone. Ziheng, good evening. Xing, good evening to you too. And who is this? Patrick, right? Hello, Patrick. Melissa, good evening as well. The US stock market is currently falling across the board. Yeah, that's right. It's the same with gold. Anyway, to sum it up, if in the past week or two during recent trading days, you've maintained a certain rhythm, meaning remember to take profits when prices are high and then clear your positions on pullbacks and look for good buying opportunities, if you've been doing that, selling high and then looking for good companies to buy when prices are low, then today's drop in the US stock market can just be seen as a normal correction after a strong rally. Alright, as for the economic data, since the US government has gradually reopened, we might start seeing a lot of data being released as early as next Monday, or even mid-November, and continuing through the end of the month. And as for these data releases, as I always say, focus on the most important, most timely, and most up-to-date data. As for the data from August, September, and October in the past, you can use them as a reference, but they might not actually have a real impact on the current market. What matters more for the current market is still the very latest data, because the data from September and October, given the US government shutdown, some of the data couldn't fully capture the real situation or the actual numbers. Since you can't get the real numbers or the real story, there will inevitably be some deviations or discrepancies when the data is released, okay? So for the data from September and October, we think it's fine if it's published, but just remember to view it neutrally. That includes some data like we mentioned yesterday, such as the monthly and yearly CPI and the core monthly and yearly rates. At the very least, we need to have a sense in our minds, regardless of whether the data released is a revised value or the latest value, you should at least have an idea that in the past 2 months, some important economic data, including things like CPI, PPI, and the original PPI, might be affected. You should at least understand roughly which range these figures fall into. You need to have a mental anchor and a firm stance, anchoring yourself to this range. That way, when new data is released later, you can make comparisons and know whether it's more favorable or unfavorable for the economy. Let me also briefly add something for everyone today. It might not be released tonight, but you should still have an idea in your mind. I'm talking about the US PPI, both the monthly and yearly rates. As for the monthly rate, the previous data was minus 0.1, and the annual rate was 2.6%. Now, regarding the core PPI, PPI stands for Producer Price Index, the core PPI's monthly and annual rates were 0.2% and 3% respectively. All right, let me say it again. The monthly rate for this time was minus 0.1 last time, and the annual rate was 2.6. For the core value, it's 0.2 and 3%. You'll notice that these numbers are actually quite similar to what we talked about yesterday with the CPI. Just remember one anchor number, whether it's PCE, PPI, or CPI, all these monthly rates right now seem to be staying between 0.1% and 0.3%. Yeah, 0.1 to 0.3. As long as it stays within this range, inflation isn't necessarily out of control. For future data releases, whether revised or new figures, just remember, if they're within this range, there's nothing to worry about. Also, for the annual rate, whether overall or core, what's the full range? They're all within 2.8% to 3.1%, so as long as future data falls within this range, you really don't need to worry too much. Okay, so just remember this and you'll be fine. As for things like the monthly retail sales rate, last time the figure was 0.6%. You can just use this as a reference, since there will be a lot more data coming out later. When those are released, we'll go through and explain them to everyone one by one. So yesterday and today, I just wanted to quickly add some info about CPI, PPI, and things more closely related to inflation. You need to know those anchor values, okay? Make sure you know them. Alright, so Little Donkey, good night, and also Min 9375, hello. Hey, who is this Guai? Is that how you pronounce it? Guai? Hello. And also Yi, I love Jialin Yi 902502, good night. And also Gao Zian, good night too, good night. Okay, let me ask everyone something. I said I wanted to do a little poll with everyone, right? Oh, and hello to the staff. A lot of students are online today. Hello. Remember, if you're online, please help us by liking, subscribing, and sharing. And while we're at it, let me ask everyone, because this week I'm doing a live stream, but next week I'm going on vacation. Yes, vacation. I'll be off for 7 days. It's been a long time since I had a real break. This is my first long vacation this year, since January. So next week I won't do the usual good night live stream, as I'll be away from Taipei for all 7 days. I'm just gonna relax, take a vacation, and recharge. Once I'm back, I'll share my experiences with everyone. I'll talk with everyone about the places I visit and maybe discuss market trends or share my travel experiences. I also want your opinions. Many of you have watched the Good Night Show in the group for a while now, right? Whether you're new or a longtime viewer, it's the same for everyone. In the Good Night Show, the program always includes discussion about the overall economy. We talk about industry trends, interpreting economic data, and analysis of individual stocks, US stocks, and more. Sometimes we cover fundamentals, do some teaching, or discuss psychological aspects too. Why not write down your thoughts? For example, take my show, Teacher Jank's program. You've been watching for quite some time. Some of you for a year, some for 2, no matter how long. Is there any particular type of content you want to hear more about on the show? If there's a certain topic you want to hear more of, let me give you an example. For instance, if you want to hear more analysis on the overall economy, just write that you want to hear more analysis on the overall economy. If you want to hear me talk about historical stories, that's fine. You can say, I want to hear Teacher Jang share more historical stories, or maybe travel, variety shows, or food journeys. Those are okay too. Or if you're interested in fundamental analysis or want to know about technical analysis, that's also an option. Or maybe you want to hear about interpreting chip data or the fundamentals of individual stocks in the US market. Anything like that, you can write down whatever you want to hear. This also includes things like some people might want to hear more about what trading strategies are, the psychology of investing, or different investment approaches. All of that is fine. Even things like interpreting news, gold, crude oil, or foreign stock markets, there are many topics. As for Taiwan stock market components, we probably won't talk about them. We rarely discuss Taiwan stock components, mainly because the main purpose of the Kunying website's program is to provide news and information before the US stock market opens. So the focus of the Good Evening program is more on US stocks, mainly US stocks and macroeconomics. If you want to hear about Taiwan stocks, you'll need to check out our General Manager Fans Morning Call program in the group. Morning Call covers everything about Taiwan stocks and the international scene. But the evening program, aside from Taiwan stocks, pretty much covers everything else under the sun. So feel free to leave your feedback. Go ahead and write it down. Maybe you'd like to hear more about certain topics in the Good Evening program, or maybe some of you hope the teacher can interact more with everyone online. For example, if students have questions, you'd like them answered right away. Things like that. You can write them down too. Since the show covers everything, just leave your comments as much as you can. After class, I'll go through them one by one with everyone. We'll do a little survey on this. So once again, I want to ask for everyone's opinions. Do you want to hear more about macroeconomics, more about data, fundamentals, technical analysis, psychology, or maybe just want to hear me tell stories? Anything is fine. I also said I hope we can interact more, and that's fine, so feel free to leave comments. Next, let's look at the FOMC official section, which is very important. Why is there still a lot of pressure before the US stock market opens today? Yesterday's pullback, along with today's drop, you can see that both the Magnificent 7 and the non-Magnificent 7 stocks are all declining. Over the past week, some small cap, mid cap, and even large cap stocks have been pulling back. And of course, the main reason for this pullback is largely because the Federal Reserve's December rate decision leaned more toward a hawkish stance. It's gradually coming to the surface. A hawkish stance means that in December, the Fed will likely keep interest rates unchanged. We've mentioned before that if rates remain unchanged and then are cut, that's a positive for the stock market and the economy. But if rates aren't cut and just stay the same, then the market tends to interpret that more negatively. You'll see it as a negative. On the other hand, right now there are a lot of officials, like who? Like Daly, Mester, or Harker. These three committee members, whether they have voting rights or not, are all showing the public a certain stance. Right now, talking about a rate cut in December is still way too early. Plus, they also mentioned that inflation still feels pretty sticky, and even the most hawkish among them, Harker, said so. Harker doesn't have a vote this year, but it's still worth paying attention to what he says. He mentioned that he doesn't think the current interest rate level is actually restrictive, and if it's not restrictive, what does that mean? It means he wants rates to stay the same to keep inflation under control. So over the past week on our show, we've been keeping track of a lot of officials, whether they are board members, have voting rights or not. Almost 60 to 70% of these officials are basically looking at keeping interest rates unchanged in December. At most, there are only a few exceptions. For example, some board members favored by Trump, or those he prefers, like Waller, Bowman, or Mester, support another rate cut in December. Mester even suggested that there could be 2 rate cuts in December. But of course, from what I see right now, the chances of no rate cut in December are still over 50%. Because of this gloomy outlook, we're seeing a lot of pressure on the US stock market in pre-market trading. Of course, taking advantage of this pullback or correction allows stocks that had previously surged too much, whether in the US or Taiwan, to undergo a reasonable adjustment. In fact, a moderate correction like this is actually healthier for the market's future trend, as long as certain key levels or critical stocks don't break through their lows, crash, or form a technical top on the charts. If none of those things happen, then you can view this recent correction as a healthy pullback after a strong rally. But in a moment, I'll share with you which signals or patterns you need to watch out for and be cautious about. The pullback period will be even longer, but for now, you can just observe for a bit. Just watch for now, because after all, the official statements are still relatively hawkish. The officials are leaning hawkish, but Trump is more dovish. Trump wants rate cuts, Trump wants the stock market to do well, so it's basically a tug of war between the two sides. Also, we're saying that once the US government reopens, of course there will be a lot of things to deal with. For example, there are 600,000 federal employees who will all be coming back to work. When they return, there are issues like how their salaries will be paid, how departmental adjustments will be made, and how economic data will be released. There are a lot of problems that have to be faced after reopening. As for Trump, oh, good evening, ON. Good evening, ON. Good evening, OK. And good evening to me as well. So if y'all feel that if you think the current situation's pretty good, you can also write that you'd like to keep the content of Mr. Jiang's current lectures as it is. So if you want to hear more about a certain topic, just write down which one you want to focus on more. But if you want things to stay the same, you can just write, keep things as they are for now. For example, Hector or TH or TFUC at 8, you can also say you'd prefer to keep things as they are right now. All good, fine, just leave your thoughts. Okay, ACO, this name is a bit long. ACOH, something like AD something income. This is really long. And then the numbers, 9,628. Good evening. Hello. Hello. All right, let's take a look at what Trump and his set talked about. Trump said that the current signing, this appropriations bill, has already passed. With the appropriations bill passed, just remember that this bill will ensure that the entire U.S. federal government has at least enough funds to operate smoothly at least until the end of January next year, so there won't be any rush. So before the end of January next year, with the government having enough funds, both the U.S. stock market and the government will remain open. But by the end of January next year, these funds will run out again. So everyone needs to be mentally prepared. At the end of January next year, the Republicans and Democrats will once again argue over whether the government should stay open or shut down. Yes, they'll argue about it all over again. It's just that for the next 2 to 3 months, there probably won't be any arguments about this issue because the government has money now. As for what Trump said, he claimed that this government shutdown has already caused $1.5 trillion in losses. As for the actual total losses, they still need to do the calculations. A more concrete figure comes from Hassett. Hassett said that this shutdown has resulted in the disappearance of 60,000 private sector jobs. They just vanished. In addition, the economic loss is as high as $1.5 billion per week. And also, the employment data for October might be released soon, but the unemployment rate data won't be published. Why? Because you don't have enough material. Your data's all gone. No one's at work, so there's no one to collect and compile the statistics. Naturally, you can't produce the unemployment rate data. But the non-farm payroll numbers might still come out. So what they're saying is that because of this government shutdown, the US GDP for the fourth quarter will decrease by about 1.5%. It's not quite a recession yet, though. For example, let's say that under normal economic conditions, maybe the US GDP for the fourth quarter would be 2%, or let's say 2.5%. So what they're saying is, because of the shutdown, since the economy can't function properly, can't operate as usual, it will cause the GDP to drop by 1.5%. So originally it was 2%, but if you subtract 1.5, this impact would mean the fourth quarter GDP is only 0.5%. Now, as for whether it will go from positive growth to negative growth, or even a recession, we don't know yet. We really don't know at this point. However, they did say that there has already been a permanent economic loss of about $7 to $15 billion, which is quite a lot. So this argument also echoes what the Federal Reserve said, that the economy could possibly see a recession in the fourth quarter. Because of this kind of government shutdown in the US, the impact is huge, and there are some permanent losses. So as he told Director Lin, because of these kinds of events, if the economy slows down or even goes into recession in the fourth quarter, you need to cut interest rates quickly. All right, you hope to cut interest rates as soon as December, keep that in mind, but in other words, if Federal Reserve officials can't see the economic data, can't see employment, can't see inflation, and are unable to make decisions or take action, then no matter how much Hassett or Trump forcefully call for rate cuts, if the Fed officials just don't see the data, then they won't dare to take any action. Under these circumstances, maybe the Fed will still keep rates unchanged in December. If they do stay unchanged, and then in quarter four this year, the gross domestic product really does decline again, then things will get a bit tricky. It would mean the economy is slowing down. If the Fed still doesn't cut rates to address the situation, that would be even more unfavorable for the stock market. So what would happen? At that point, Trump would jump out. He'd be even more anxious than us. If the economy is declining, the Fed doesn't cut rates, and the stock market drops, Trump would be the first to react. We'll have to see what kind of show Trump puts on. This kind of shock and volatility brings more uncertainty to the stock market, so everyone needs to be careful with position sizing and risk management. Just pay more attention and be cautious. It's not likely to turn into a full-blown bear market just yet, since after all, there's an election next year. But increased short-term volatility, that's definitely going to happen. So keep an eye on the probability at different timeframes. All right, that's it for this part. Okay, good night to Jeffrey, and good evening to Brother Yulin as well. Someone mentioned that keeping the maintenance margin unchanged is also fine. Okay, that's good. Anyway, just leave your comments, and I'll go through them one by one to tally up and respond to everyone. For example, in KK2, we discussed the overall trend of the US stock market, individual stocks, and fundamentals. That's what we're talking about now. If you want me to cover more topics, just write them down. No one has written that they want to hear me tell historical stories, which are a bit more pleasant. That's okay, just write down your thoughts. As for the US Treasury yields during the experimental period, they're around 4.125. The overall interest rate remains about 3.75. The number of rate cuts is still expected to be quite low, within 0.5 times. Overall, looking at the market atmosphere and the actions of Federal Reserve officials, it seems that the chance of a rate cut in December is honestly not very high. For the US dollar index, it rose slightly today by 0.13%, still above the monthly and quarterly moving averages. But resistance to more gains is the falling 200-day moving average. Now, it's fluctuating and consolidating among these three moving averages. Alright, now let me briefly add a bit about crude oil and geopolitical risks. If you trade crude oil or follow its prices, just take a quick look. Because if crude oil prices keep rising, it will have a negative impact on US inflation. That's because if oil prices go up, it tends to be bad news for inflation. If inflation keeps rising and rising, the pressure on the US economy will get heavier, and the Fed will be even less likely to cut interest rates. That's why in every episode of our recurring program, we always mention geopolitical risks and talk about the situation with crude oil prices. After all, crude oil makes up a significant portion of the energy component in the CPI data, so the ups and downs of energy prices do have an impact on the CPI and inflation numbers. Alright, about the IEA monthly report. The IEA monthly report says that this year, global crude oil supply will increase by 3.1 million barrels, and next year by 2.5 million barrels. Both figures are higher than the previous estimates, meaning supply is increasing. However, it also says that this year, global crude oil demand growth is 788,000 barrels, and next year it's 770,000 barrels, which is actually an upward revision compared to the last data. Now, here's the key point. Some of you might be thinking, teacher, if supply is increasing, but demand growth is also increasing this year and next year, shouldn't that at least mean demand is going up? Yes, even though the demand growth for this year and next year has slightly increased, according to the IEA monthly report, after tallying up the total statistics, it shows that next year, global supply will still exceed demand by nearly 4.1 million barrels per day. That's per day, 4.1 million barrels per day. So in fact, supply will outpace demand. And he also said that it's not just next year. Even just looking at this year's fourth quarter, the growth in crude oil demand is slowing down while supply is increasing. In other words, in the fourth quarter, there will still be pressure on crude oil. Although the forecast is for a slight increase in demand growth for this year and next year, overall, the market is still in a situation where supply exceeds demand. You might ask, teacher, why did crude oil prices go up today? Let's see, it rose by 2.18%. Does that mean the trend will reverse? Not really, because as I mentioned, supply is still greater than demand. So why did crude oil go up by 2% today? There's actually a small factor behind it, related to a piece of news we're seeing now. Ukraine attacked Russia's oil ports on the Black Sea, hitting one or maybe even two of them. When that happened, people started to worry. Could the conflict escalate again? And after these oil ports were hit, there were concerns about whether crude oil exports might be affected or face some uncertainties. That's how it is. Small, sporadic skirmishes, little flare-ups. They might make oil prices go up or down by 1%. After things settle, everything returns to normal. In the short term, crude oil's trend is still more bearish. So today, I'll share more from the IEA monthly report. As for tonight's data, I don't think it will be released, because even though the US government has reopened, they can't publish the data that quickly. It's just something to watch. Besides the data, there are also earnings reports. Let me give everyone a quick heads up about next week. I won't be doing the live stream next week, but I still want to remind you all that on November 18th and 19th, there will be two major retail department stores releasing their earnings reports. One is Home Depot and the other is Target. Their earnings will be announced on the 18th and 19th. Then, the most important day is the 20th. Actually, the most important thing next week is in the early morning of the 20th. So after the market closes on the 19th and into the early hours of the 20th, Nvidia and Walmart will be releasing the earnings reports. So in my opinion, next week, honestly, the earnings from Home Depot and Target aren't that important. If you want to pay attention, just focus on Walmart. That's enough. So the most important day next week will be the 20th. All right, the most important earnings report next week falls on November 20th, and that's Nvidia. Along with Walmart, Nvidia is the last one. This is the grand finale, the final earnings report from the Magnificent Seven, and it's extremely important for AI. As the leader, whether Nvidia's earnings are good or not will greatly impact the entire AI sector, the so-called AI perpetual motion machine, and even the bullish momentum of the US stock market. So everyone needs to pay close attention to this on the trading floor and watch carefully. Especially Lucino on November 20th. In addition, looking at the industry side, let's take a look. Every week we recommend a US stock. Oh, every day we recommend one. Every week we recommend a US stock. I remember we also have some US stock reports, so let's take a look at Meta. There's no industry news. Meta, the first thing people are talking about is that they signed a deal with a Dutch company called Newbills. They signed a 5-year, $3 billion contract for AI infrastructure. Now, this would normally be considered a good thing. Signing a contract like this means you want to expand your production capacity, increase your orders, or grow your AI development. Originally, this should have been good news. $30 billion over 5 years. Honestly, that's not a lot. For Meta's revenue and profits, $30 billion over 5 years is only about $6 billion a year. Considering Meta's quarterly revenue is around 40 or 50 billion, sometimes even 60 or 70 billion, this is actually a very, very small portion overall. Barely anything, really. But here's where the problem comes in. So 31 billion over 5 years, at first glance, it doesn't seem like a big deal, right? But what's this money actually for? Meta is partnering up to support things like Facebook, Instagram, and other social platforms' recommendation systems. It'll also improve the efficiency of ad placements, and their own large language models will be put to good use as well. But even though this will definitely help with long-term customer retention and ad conversion, and it's a positive move, here's the problem. In the short term, it's going to increase their costs. In the short term, their operating costs will go up. Okay, so you might ask, teacher, if their operating costs go up in the short term, then it's only 500 million a year, just 600 million. How could that increase costs? The issue isn't about the annual increase of 600 million. The problem is the current market climate, which is because of the AI industry and AI companies. Every one of them is investing too much, spending too much capital, but none of them have seen any real, tangible, positive cash flow coming in. So people are worried. What if these companies like Oracle, Meta, and so on keep taking on debt and keep increasing their capital expenditures, but the money hasn't started coming back in yet? Could this create pressure on their debt financing or lead to so-called cash flow problems? This has been one of the main issues that the market has been struggling with over the past week or two. So when you ask if 31 in 5 years is a lot, it's actually very little. But right now, because of the current market, even if these companies spend a bit more or have slightly higher costs, it gets blown out of proportion. So it's no longer about whether it's 31 over 5 years, it's already become an issue of market sentiment. So today, whether they sign a 5-year $3 billion deal or a 5-year $300 billion deal with the Dutch company Nubius, it doesn't matter. The market just thinks, Meta, why do you keep spending money? Why do you keep spending money? And then after you spend all that money, you also set aside something. Like in the third quarter financial report, you mentioned setting aside some kind of estimated prepayment for income tax. It was a one-time recognition, so Meta's third quarter financial report showed pretty good revenue, better than expected, but the EPS was way off from expectations because they recognized this one-time expense. And in this situation, you're also increasing investments with someone or signing more contracts with someone. So what happens? You know, people will look at it from different perspectives. Otherwise, if you look at it from a 5-year, 3-dividend point of view, in fact, for the company's future and its mid to long-term development, this is actually a good thing. But the market is just that unpredictable. The market is just that unpredictable. When the market sentiment shifts, even the slightest disturbance can turn good news into bad news, and current bad news can become even worse. That's the kind of situation we're seeing now. So Meta saw a slight increase of 0.14% yesterday, but basically, before the US stock market opens today, a lot of tech stocks are trending down. They're all heading lower. As for Meta, this particular neckline, actually, on the day they released their earnings report in October, on October 30th, the price just plunged straight down and broke through the neckline. Now, as we've mentioned before, if the price falls below the neckline on the day it breaks, but then recovers and closes above it, then it's not a big deal. Unfortunately, after it broke below on October 30th, it never climbed back above the neckline, not even that day. Since it never got back above, once the neckline was broken, it formed a short-term top. With this top in place, the situation still leans toward a short-term correction, with bears still in control. In the long run, it's still bullish, but in the short term, Meta is under bearish pressure, so everyone should pause and observe for a bit. After all, among the Magnificent Seven, it's one of the first where all the monthly and quarterly moving averages have started to turn downward. This means that the short-term bearish pressure is quite strong, and it has broken below this blue neckline, so just pay a bit more attention, okay? In the short term, we can only quietly wait for it to stabilize and stop falling. Otherwise, from a technical or chart perspective, there will be significant pressure. So that's a quick update on Meta for everyone. Now, moving on. Right, someone mentioned that constantly issuing government bonds is also a problem. For example, Oracle issued bonds, was it 33 billion or 38.1 billion US dollars? Meta is also issuing bonds, but what's interesting is that whether it's Meta or Oracle, after issuing, they're always oversubscribed. For instance, if I issue 30 billion, there might be 120 billion wanting to subscribe. So investment banks, the public, or institutional investors are very eager to buy these corporate bonds, that's for sure. It's just that now the market is thinking, if they issue 30 or 40 billion dollars in bonds, such a large amount, will they eventually run into cash flow problems or be unable to pay back the money? This kind of concern is basically a panic triggered by fear. It's a panic caused by my own worries and fears, but if you ask me, will Meta or Oracle really run out of cash by next June or next October and then suddenly face a huge shortfall, eventually leading to bankruptcy because they can't keep things afloat? Right now, it seems like the chances of that happening are actually quite slim. It's extremely unlikely. It's very unlikely, because it's not like they don't have money. They make a lot of cash every month, every quarter, but the market is worried because they're taking on so much debt at once, so it seems like there's a lot of pressure. But do you really think that when the time comes, they won't be able to pay? I don't think so. I think they'll still be able to pay. It's just that right now, the market is a bit nervous. Now, let's talk about Apple. At the moment, among the 7 giants, Apple is just behind companies like Google. If you think about it, just behind Google, in the US stock market, there are only 2 major stocks really holding up the market. Just 2, and that's Google and Apple. Now, there's some news today. Besides the fact that the iPhone 17 is selling well, there's also news about Apple and Tencent. Everyone knows Tencent from China. What's the most famous software under China's Tencent? It's WeChat, and WeChat has WeChat Pay. Back when I was working in mainland China, because I'm at Foxconn now, when I was working in mainland China, basically, when you use your phone there, you won't have Facebook because it's blocked, unless you use a VPN to get around the firewall. So you don't have Facebook, you don't have Instagram, you don't have Line. So during that period when you work in mainland China, basically, you can't open Line. It's just not possible. Every time, after more than a month, when you come back to Taiwan and open it, it goes ding, 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 and there are thousands of messages. When you return to Taiwan, you get thousands of messages. It's that kind of situation. So what do you use in mainland China? What do you think you use? You just use WeChat. WeChat is actually pretty good to use. Anyway, everyone in mainland China uses WeChat. Everyone. Even when you buy things or eat out, you use WeChat Pay. You don't even use cash. If you go to McDonald's or even convenience stores or even a street food stall to grab a snack, some of those vendors don't even accept cash. Why? First, because it's a hassle, and second, they're afraid of counterfeit bills. Afraid of hassle, afraid of fake money. So what do they use? They might use something like Alibaba's payment system or WeChat Pay, especially WeChat Pay, which is the most common. You just take out your phone, and if you have WeChat, you scan the code and pay with WeChat. That's basically how it works. Pretty much everything we eat or use is paid for with WeChat Pay. So in mainland China, the adoption rate of WeChat is extremely high. You have to know that all of mainland China, there are nearly 1.4 billion people, so the business opportunity here is absolutely huge. So why am I talking about this? Because of WeChat, because of Tencent, of course WeChat's parent company is Tencent, Tencent's stock price has also skyrocketed. It's really impressive. So what did Tencent do today? According to a Bloomberg report, Apple and Tencent have reached a revenue sharing agreement. Now, this is interesting. What kind of agreement did Apple reach? It says that from now on, Apple will handle payments for some of WeChat's mini games and related apps, and Apple can take a 15% cut from these purchases. 15%? So you might say, teacher, this 15% revenue share is clearly what Apple calls the app tax. Basically, for a lot of companies, if you want to put your app on Apple's App Store, like all kinds of apps and services, right? When you buy the app, you have to pay Apple because Apple provides this channel, this app store for you to use. So whenever companies put their apps or software on Apple's platform, as long as they make money or charge users, they have to share a portion of the revenue with Apple. This is what's called the Apple tax, the so-called Apple tax. When calculating this, here's how it works. If your company makes money from your app, if I remember correctly, it's $1 million. Yeah, 1 million. If I'm not mistaken, if your revenue is over 1 million US dollars, Apple will take 30% from you. If you make more than $1 million, they take 30%. That's $300,000. So out of that $1 million in revenue, if you go over, you'll be charged a 30% Apple tax. But if your revenue is within 1 million, if it's under $1 million, then they only take 15%, just 15%. So you might ask, in this revenue sharing deal between Tencent and Apple, they're actually using the lower rate, only 15%. Doesn't that mean Apple is making less money? Is Apple losing out here? Oh, no, no, no. Do you know why? Because before, with all those WeChat mini games and WeChat app payments, Apple couldn't get any money from them. Apple had no way to take a cut from that. They used to be zero. Before, there was no money at all, but now they can take 15%. So it's not that they're earning less, it's actually a nice little bonus. It's not about earning less, it's about getting a little extra, because before it was zero, and now it's 15%. Sure, it's not the full 30%, not the industry standard 30%, but at least they know they can get 15%. So getting this 15% is already pretty good. Do you know what the benefit is? After Apple and WeChat, or Tencent, started working together, Apple is now opening up what? They're opening up a new market for minigames in China. A lot of people like to play minigames on WeChat. Here, maybe in Taiwan, not many people use WeChat. Very few people in Taiwan use WeChat. In Taiwan, people use Telegram, WhatsApp, and especially Line. Line is the most popular. Hardly anyone uses WeChat here. If you go to the mainland for work or travel, you might use it. So the 15% will help Apple's revenue and ease Tencent's payment pressure. Tencent originally had to pay $380,000, but now only 15%. But don't forget, WeChat is like a small city. WeChat is a city, and these minigame apps are everywhere in mainland China. There are 1.4 billion people who all have to use WeChat. No one in the mainland dares to use Line unless they use a VPN. If you use a VPN and get caught, the police will come and arrest you. They really crack down on that. So you can't just casually use a VPN to comment on Facebook, YouTube, or whatever. You just better not get caught. It's basically a case of turning a blind eye, so the vast majority, 99.9% of people in mainland China use WeChat. That's why there are 1.4 billion active or semi-active users. So in fact, this is something that going forward is actually beneficial for Apple. Breaking into the Greater China market is actually helpful. For UK competition and the appeals court, just note this news. Nothing is finalized yet. Read it to stay informed. Even though profits were cut in half, Apple has entered the huge Chinese market. They used to make nothing there, but now they earn 15%. As for the stock price, it dipped slightly yesterday by 0.19%, but you can see. On the technical side, it's still holding above the monthly and quarterly moving averages. Actually, when the US stock market experiences a significant pullback, you'll notice that whenever there's a big correction in the US market, when all the big and small stocks, every Tom, Dick, and Harry are dropping, who is it that often rises? Who is it that often props up the market? It's usually Apple. It's like when everyone else is drunk, I'm the only one sober. When everything else falls, the one holding up the fort is Apple. You can see that this has been the case in the market these past few days. Everything is down. The whole market is a sea of green. But Apple is in the red. Why? Because to some extent, Apple carries a lot of weight, so it plays a key role in holding up the index, kind of like what TSMC does in Taiwan. It's that kind of vibe, you know? So as long as Apple's monthly and quarterly moving averages aren't broken, in the short term, it's still relatively bullish compared to other stocks. So, just to add a bit of industry news for everyone, here's an update about Apple. It's collaborating with Tencent. Alright, next, let's talk about how Brother Maggie took a hit. We're talking about Bitcoin. A few days ago, I saw, who was it if not Brother Maggie? Oh, it was Stanley Huang. Or maybe Li Hing Huang? I can't figure it out. Anyway, he said he was playing with Bitcoin and got liquidated, losing billions. Yeah, lost billions. Billions probably means in new Taiwan dollars, and he said he went bankrupt. Whether this news is true or not, honestly, we don't really know. We really don't know. Anyway, the point is, you play around with Bitcoin, and in the end, it goes from over $120,000 and suddenly drops to $90,000. But if his cost was, say, if his cost was at $1,000 or $3,000, honestly, even if it drops from $126,000 to $95,000, it doesn't really make a difference. This is on the premise that you bought in early enough. If you got in early enough, then it doesn't really matter. But if you got in a bit late, it's gonna be tougher. Alright, now let's talk about the earnings report. What exactly is the original sin of Applied Materials? As for Applied Materials earnings, we'll just go over it briefly. In both the third and fourth quarters, their earnings basically met expectations. Their annual revenue was $28.4 billion, a 4% year-over-year growth. The CFO and CEO said this would be the 6th consecutive year of positive growth. Overall, things look pretty good. Making a splash in the US market is great, right? Except for the gross margin, which was 48%. Just a tiny bit below expectations. Really, just a hair, less than 1% off. But both revenue and profits were solid across the board. So why did the stock price actually drop 3.25% yesterday? Why? A big reason is because of the so-called original sin issue. What does original sin mean here? There are two main points. First, the CEO said that the ongoing demand for AI is driving semiconductor growth, but he also mentioned that for the 2026 fiscal year, there might be a 600 million decrease in revenue. The reason for this 600 million drop is because of the Chinese market. Because of US export controls, what do US export controls cause? They lead to a decline in revenue from China. So it's this issue that's having an impact. Of course, the US-China trade war has an effect on Applied Materials. It's said that by next year, revenue might decrease by $600 million. This is an original sin. There's nothing that can be done about it because the US-China trade war affects every industry to some extent. This is the second principle. What is it? If you ask if Applied Materials is doing well or if its financials are good, the answer is yes. The outlook for the next quarters and year is positive. So why did its stock fall? What's the main reason? That's it. Currently, the market's position and sentiment show AI is in a correction. AI investments are high, so money can't be recouped now, and AI may be taking on a lot of debt. That's why, starting from Oracle's drop and the decline in this beta, all EVA risks triggered a significant pullback. So why do we say this is an effect of market sentiment? Let me explain this to everyone. The CEO said in this earnings report that due to export controls, next year's 2026 revenue might decrease by $600 million. Is $600 million a lot? Not really, since the revenue is $28.4 billion. $28.4 billion! So even if it drops by $600 million, that doesn't justify a 3% drop in the stock price. There's no direct impact or conflict. Also, this $600 million decrease wasn't just revealed in yesterday's earnings report. This $600 million decrease was already mentioned before on October 2nd this year. He said then that due to export controls, revenue in 2026 would drop by $600 million. But that was back in October. At that time, he said revenue would fall by $600 million, but the stock price went from $220. It kept going up, rising for a month, up to $240, a 10% increase. Strange, right? Didn't he say there would be a $600 million decrease? So why did the stock price go up? Because from October to early November this year, all the AI stocks were still extremely hot. Everyone was still enthusiastic, and things were just crazy. So no matter what good news or bad news came out, whenever there was a dip, everyone saw it as a buying opportunity. When there was good news, people thought, wow, let's keep buying, keep adding more. So even though in October they announced the negative news of a 600 million decrease, the overall market sentiment at the time was still very optimistic. You have to understand what this means. Why call this the original sin? A month and a half later, they announced a $600 million loss, and the market magnified it. Wow, $600 million sounds huge, but wait, that's strange. Does that mean the 10% increase last month was fake? Oh, so this is what I mean by original sin. The US-China trade war, it's clearly the same piece of news, exactly the same news. But because the context and atmosphere at different times are different, the market's interpretation and perspective can be completely different. So it's still 600 million, that hasn't changed. Since the price dropped, let's pay attention. Yesterday, it fell 3.25%. The earnings report was good, but it still dropped 3.25% and broke below the 20-day moving average. If it can't get back above the 20-day moving average soon, which it might not, that's something to watch. If it can't get back above, then the next support level on the downside would be the quarterly moving average, which is the green line. Right now, it's moving closer to the quarterly moving average. Okay, so in the short term, if you're really trading short term and if you don't have a position, there's no need to chase it. But if you do have a position, you should be mentally prepared that it might slowly move down to test the support at the quarterly moving average. It usually tests in the direction of the moving average, unless today or tomorrow it can immediately get back above the 20-day moving average and reverse this downward trend, only if that happens. But for now, it looks like the market's pullback or consolidation over the past week still seems to be ongoing. There's still some pressure here, so it probably won't rebound that quickly. So regarding applied materials, let me just add a bit more for everyone. Honestly, it's just numbing and confusing retail investors. Everyone's kind of numb to it now. In the last bit of time, let's talk about Disney. Disney's earnings report has also been released. As for Disney's earnings, well, third quarter revenue missed expectations, but the disappointing part was actually expected. Disney has many divisions, TV, entertainment, and more, and all are declining. Year-over-year growth is down 6%, and operating profit dropped 35%. Many cable TV and other segments are in decline. Because of this, the stock fell yesterday, dropping 7%. That's Disney for you. The only part that's actually growing is Disney's theme parks, resorts, and cruises. That segment's making money because everyone loves going to Disney, so that area actually saw a 13% year-over-year growth. So aside from the parks doing pretty well, every other division under Disney is declining. Literally all the others are down. So keep an eye on this because it's a bit of a shame. Before Disney released its earnings report yesterday, it was actually doing pretty well. It was holding up strong, really quite resilient. It was holding above the 200-day moving average, but what happened with yesterday's news? As soon as the earnings report came out, it immediately plunged 7%, breaking below the 200-day moving average. From a technical analysis perspective, you need to be a bit cautious here, because every time it touched the 200-day moving average, it would go up, almost every time. Whether you look at the past, from July this year until now, every time it hit that yearly line, it bounced. How many times did it touch? 3 times. It touched 3 times, as we've mentioned before. We've talked about this before, remember? Whether it's an upward or downward moving average, it doesn't matter. As long as a moving average is touched more than 3 times, usually the strength of that moving average as support or resistance starts to weaken. Its reference value will decrease, and that strength will get absorbed or digested. Let me say it again. Any moving average, especially the monthly or yearly moving averages, it's the same for all of them. As long as a moving average is touched 3 or more times in a row, the pressure or support effect of that moving average will usually weaken. If you look at Disney, it also touched it 3 times, at least more than 3 times. When it hit the yearly moving average for the 3rd time, it was still okay. The 3rd time, it actually broke upward pretty well, reaching up to $115. It felt like the outlook for this stock was pretty good, right? But unexpectedly, after yesterday's earnings report came out, boom, it dropped straight below the yearly moving average. So in the short term, it's better to pause and observe for a bit, unless it manages to climb back above this brown yearly moving average. Otherwise, the pressure for further downward correction will increase. Regarding Disney, one last thing as we continue with the US pre-market. For Shanghai companies, aside from that, Warner Bros. Rose 3%, Halliburton, no, not Harry Potter, rose 1.92%. Also, Apache, ConocoPhillips, Occidental Petroleum, and other US oil companies in pre-market today all rose about 1.1 to 1.5%. Why? Crude oil prices. Today, from what I see, it went up by a little over 2%. So you can see that in the US pre-market today, some oil companies, or let's say energy companies like Chevron, Occidental Petroleum, and ConocoPhillips actually all saw gains, around 1% or so. And that's just because crude oil prices went up. But you should just treat this as a short-term move. Whoa. As for the companies that dropped, it's mainly tech stocks that are under pressure. Maybe today, whether it's in the US futures market or even in the Taiwan futures market, it's the same situation. The pressure on the US stock market in the UK session is likely to continue. Yesterday's sharp pullback was mainly due to 2 reasons. First, the US stock market reopened, and people are worried that after reopening, because of this, the US GDP in the 4th quarter might decline, which is a concern. The second reason is what I just mentioned. Many Federal Reserve officials are taking a more hawkish stance on monetary policy, so it looks like interest rates will likely remain unchanged in December. Of course, keeping rates unchanged will put some constraints on the momentum of capital flowing into the stock market. So what about the US stock market? In pre-market trading, Applied Materials is down even more. Before the US market opened, Applied Materials dropped by 5.5%, which is significant. As for Tesla, its drop is because Cathie Wood from ARK said she sold 4 times in a row. Honestly, even though she sold 4 times, the number of shares sold wasn't that large, not extremely exaggerated. It's just market sentiment. When there's talk of interest rates dropping, most stocks go down. Everyone is watching, and before the market opens, it dropped another 3.6% to 387. Companies like Coinbase and Robinhood in the US pre-market are also down about 3%. Intel, Palantir, Nvidia, Supermicro Computer, AMD, Synopsys, and even Dell, all these American companies, including Atora, are seeing pre-market drops in the US stock market, with declines ranging from 2% to 3%. Today, pressure on the US stock market remains high. The Dow Jones dropped 1.65% yesterday, but it's still above the monthly moving average. Among the 4 major indices, the Dow appears most resilient, holding near the quarterly moving average. The 50-day moving average should remain intact, with the Dow likely staying above it. For the Philadelphia Semiconductor Index, SOX, we need to pay more attention. The SOX has dropped below the 20-day moving average. It broke that level. Next, watch the quarterly moving average, as it may correct toward that line. Keep an eye on support at the quarterly moving average. Yesterday, it fell 3.72%. As for the Nasdaq 100 index, it also dropped 2.7% yesterday. Of course, the decline was broad-based, just like we mentioned earlier. Apart from Apple going up, almost everything else, including Tesla, went down. So the index corrected all the way down, performing even weaker than the SOX, and went straight down to the 50-day moving average. This is actually the first time in the past 6 months that it has corrected down to the 50-day moving average, so you need to be a bit cautious here. Pay attention, as there will be more short-term pressure, and the correction and consolidation pressure in the short term will be greater. Although it's not enough to call it a bear market, you still need to respond cautiously during the short-term pullback. Traditionally, looking at the past, the fourth quarter is usually a period of gains. Don't forget, things can always play out differently, and there can be unexpected changes. For example, in September this year, everyone thought there was some kind of historical curse and that September would see a drop, but unexpectedly, September actually saw a big rally. So for this year's fourth quarter, while the market originally expected the traditional fourth quarter to go up, it's possible that instead we might see some sideways movement at higher levels, so of course we need to pay close attention and stay alert. Alright, that's all for the regional market update. Before the stock market opens, we're bringing you the latest information. If you found this helpful, please remember to like, subscribe, and share during the break. We also hope you'll leave your valuable feedback so we can keep improving and developing. Finally, I wish you all smooth trading and see you next week.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.